Joining us now is Jeff Sherman, DoubleLine Capital Deputy Chief Investment Officer. And Jeff, it's great to have you, especially with so much fast-moving action and expectations in the bond market here. Did today's, I guess, the hints that the Fed is looking perhaps for an opportunity to slow things down change the picture much at all? It seems like it's pretty well in sync with what the Fed told us in September, but maybe the market had kind of moved ahead of it.
Yeah, I don't think there's really anything new there. I mean, we were discussing this across the desk today, and effectively, this is all about inflation fighting. And this is a week where we didn't get really new inflation data, but guess what? Next week we do again. So it's like every other week is something we're getting here. But the comments are consistent with what the Fed has been telling us. I mean, they're telling us that they're going to hike. They're following what the market is pricing in. And the market still has another 175 basis points of hikes priced in over the next 4 meetings. And so ultimately, it doesn't seem like they're really slowing down much. It's just all that was being conveyed there is that, well, we're probably not going to do a bunch of more 75 basis points hikes. So we've been advocates that the Fed should slow down. But they're going to have to see the inflation data start to cool in some capacity in order to do so. And so I think the reversal today doesn't really make a lot of sense, seeing the front end rally, the back end sell off. Again, this is all about inflation fight at this point. And really, I think, until we see some cooling of that data, you're going to see just these whipsaw behaviors within the Treasury market.
Well, I mean, if the pullback in yields today, the reversal, as you say, doesn't make a tremendous amount of sense. It was set up by a pretty dramatic upside move in yields, right? I mean, it looked like it was almost gaining downside momentum in terms of bond prices. So it seemed like it was getting a little bit crashy, just how fast yields had moved. I just wonder if you think the levels we're at right now make sense based on what we should be expecting and what the market is priced in from the Fed.
No, you nailed it, Mike. And there's just been horrible momentum within the Treasury market. I would even call it carnage. I mean, if you look at what's happened over the last 3 months in the Treasury market, I mean, we've repriced from Fed expectations, what the hiking path would be at the end of it by another 175 basis points. So all the hikes I'm talking about were not even priced into the market 3 months ago. And so what we see in the Treasury market is that it's really starting to offer a fair amount of value for those who want to offset risk in their portfolios. I know it's not working today, right? We have a nice stock market rally because the market really is hinging, the risk assets are hinging on a Fed pivot. But there is no signal yet, either in the data or in the Fed communication, that they're indeed going to pivot. So I think they continue to deliver here. I think, the Treasury market is fairly priced today. I think it offers value for a lot of things that you own in your other parts of your portfolio. If we do have an over-engineered Fed, we have recession risk, it allows you to really offset some of that with Treasuries. But don't forget, the other darling of the cousin of the stock market are the credit markets. And what we're seeing in credit today, I mean, you can buy investment grade bonds that yield 8, 9+% today. So it really makes sense for a lot of investors out there to really think about balancing a lot of these risks in their portfolios. And so you talk about 15-year high in Treasuries. I mean, what we're seeing the opportunity set in credit is stuff that we haven't seen really since, the depths of the pandemic, which wasn't very tradable, but also going back to like 2009 and 2010. So from our perspective, really, thinking about the Treasury market, it is something you should be owning. You probably have a little bit more upside pressure in yields, but we're getting close to the end, I think, of this rate rise regime. It's probably a little early. Again, it's going to be very data dependent. We have GDP next week. We have inflation data from the PCE next week. And so it's going to just continue to be driven by this narrative of the Fed. And then the following week, we get the Fed. So there's a lot on the calendar. Everything is still running through the bond market, but it's starting to get to the point where as you mentioned, this negative momentum, this negative breath, is looking like an opportunity to start building positions. And that's what we've been doing over the last 6 weeks here at DoubleLine.
Yeah, it's no doubt that, clearly inflation has to moderate to some degree for the Fed to consider slowing down at all. So clearly it's predicated on that. But as you say, kind of a bit of a cushion perhaps in value being created in fixed income. Do you think the Fed potentially has already gone too far in terms of what the economy can handle going into next year? Because that's another bull case for Treasuries here. Obviously, if we worry about a recession kicking in.
Yeah, no, absolutely. And I think treasuries are a great hedge to that recession risk or the deflationary side of overshooting to the other side. And so, when you start to think about kind of where the Fed's been, we know monetary policy operates at a lag. Jay himself admits it at the press conference, which is a good thing, that they say, hey, maybe we need to take a pause at some point. And so, the market has priced this in. It's been carnage, though, right? Look at the bond market. It's down almost as much as the Dow is at this point on a year-to-date basis. The S&P is still a bit worse. But what you found is just this repricing to the market is because the inflation data has not subsided. And so, the Timuro story this morning, we were discussing it. It's very balanced, actually. It's not saying that they're going to ease. It's just saying that, look, they haven't been successful in fighting inflation either. And so from the standpoint of thinking about what you should do to interpret it is you just got to be patient. With bond investing, you don't trade it day to day. You start to build the positions. And looking forward, let's go out 12, 24 months. Could there be a recession? Absolutely. That's what the treasuries do. But if we don't get it, or we get a mild one, or it's very narrowly focused in certain parts of the market, credit offers a significant value. And so that's why we're so excited about the bond market. Looking in the rearview mirror, it's been ugly. Looking forward, it's some of the best opportunities we've seen in over 12 years.
Yeah, been a really dramatic repricing in just a few months across the bond market. Jeff, appreciate your thoughts today. Thank you.